London AIM-listed Urban Logistics REIT has built up what it says is a portfolio of quality assets. It's just made a disposal as well, which brings another £30 million onto the balance sheet. Richard Moffitt is chief executive. He joins us now. Richard, good to talk to you. Ticker number SHED. What a great ticker for a company that deals in this sort of business. Just outline, first of all, what the business model is of Urban Logistics.
Well, first of all, good afternoon, Jeremy. I think what might be helpful might be just to set the scene slightly in terms of where our assets sit within the broader logistics real estate fraternity. If you can imagine that sort of shed landscape, as I like to call it, is populated with the big box operators like Tritax, Big Box REIT and Segro. And then coming across from that, you've then got ourselves as a pure play in the urban logistics space. And then the rest of the landscape is made up with the multi-let industrial players like Stenprop. And then, of course, you've got the manufacturers who also own quite a lot of sheds in the sort of 400 million square feet of sheds in the UK. Obviously, quite a significant amount of it is manufacturing. So we're very much focused on buildings that distribute essential goods around the country. We basically say that our warehouses store essential goods that then travel on their last stem of the journey to your home or your business.
I want to talk a little bit more about the essential goods side of it in the context of how the last year has developed in just a moment. But I wanted to pick up at this point about the fact that you are Urban Logistics REIT. Explain a REIT to someone that doesn't understand it and how this plays into the business model.
I think that the important thing to understand about a REIT, a real estate investment trust, is that fundamentally a REIT needs to enjoy the benefits of not paying income or capital gains tax. We need to pay out 90% of our revenue, surplus revenue, which is clearly a big distinction from the old traditional real estate listed entities that may, for example, decide to sit on large cash piles at any given point in time for a strategy they may have opined upon. But in our case, we're all about income. We're about letting buildings and distributing that revenue to our shareholders.
Yeah, so let's go then back to that point about these essential goods. How has last year been for you? Because obviously we have, as a society that has been mostly locked down, and to some people it's been an enjoyment, but others, of course, it's been a real headache. And I know that companies like yourselves, in supplying what we need in that sort of environment, what's it been like for you as a business during the COVID experience?
Yes, look, it's been, for us, it's actually been business as usual by and large. I'm pleased to report that in the first few days even of the first lockdown, I think we only had 3 warehouses which actually closed momentarily. All of those were reopened within a week to 10 days. We implemented some management strategies around what was happening in order to make sure that we were on top of what our tenants were doing, and also making sure we were there to support them if they needed help. But luckily, because our strategy is so focused on essential goods, by and large, our customers were busy getting pharmaceuticals and food and so on around the country. We made sure we spoke to our tenants at least every 4 weeks. We managed to keep in regular contact with them. We obviously respectful of the fact that in the teeth of a pandemic, we didn't want to be going to site and interfering with their operations or indeed getting in the way. So we nevertheless still went around the country, making sure that, at least from the outside anyway, our buildings were operational and making sure that they were able to operate as effectively as possible. So I'd say overall we've operated pretty normally. And clearly it's been the biggest examination of our strategy since our IPO in 2016. But I'm pleased to report that our rents, we've managed to collect 100% of our rents for each of the 4 quarters since the pandemic. So I did joke to an investor back in January 2020, and I said, of course, you won't really know how clever we are and how good our strategy is until we get a significant downturn. I didn't quite anticipate it going to come so quickly.
Yeah, that's always a very interesting test, I think, for a company is to see how it does when it's under enormous amounts of stress. Let's talk about this deal that you've just undertaken to sell £30 million worth of property. I'm interested actually to look at the structure of the board as well, because looking on one of your pages, you've got a picture of you and the fact you're the chief executive, and right next to that is the property director, someone obviously you value in terms of the business. I know that you look at these assets regularly and you work out what's needed and what's not. And that decision-making process has brought about this recent sale where you've managed to realise 30 million. What's behind it, first of all? Because you seem to be getting rid of assets that you would otherwise use.
Yes, I think, for those that have been familiar with logistics real estate for a long period of time, what we're very anxious when we sat down and devised our strategy, we were very anxious not to repeat mistakes of the past. And I think we saw, certainly with Brixton PLC, they continue to acquire assets at increased levels of pricing to sort of justify their own portfolio valuations. And I think we've always said we'd like to see us recycling about 5% of our portfolio on an annual basis. So that's in line with the strategy we set out back in 2015-16. We found it quite difficult during the previous financial year to recycle many assets because fundamentally we had so much asset management to do. And with the impending Brexit scenario, a lot of occupiers were planning at the macro level and didn't really want to commit at the micro level. I'm pleased to say that the course of the last 3 or 4 months, we've done an awful lot of asset management, and then we're faced with the choice of whether these assets perhaps sit with some fairly stable income for the next 5-year period, where we might believe that we've got further asset management to do. But the reality is, I think we've got so much potential in our pipeline that actually recycling some cash at this stage and taking the benefit of that asset management upside would be a shrewd thing to do. It's certainly something I'd like to see.
So your investment department's made this decision to offload £30 million worth of assets. What are you going to be doing with the money that you're getting in from the sale of this part of the portfolio?
Well, the short answer, Jeremy, is that we will be recycling that cash into pipeline opportunities. We've always got a very healthy stream of opportunities to invest further equity into. So that money is already spoken for in terms of we have a development pipeline coming forward. We also have existing assets where we are refurbishing buildings to meet tenant demand. We're doing quite a lot of investment into low energy lighting and car charging points and other ESG initiatives. So that clearly requires capital expenditure. But I think just on the point of disposal, I think 1 or 2 people have said to me, are you calling the top of the market? And I think it's really important to message our investors to say that that's absolutely not the case. We've always said that if you take a short lease and you make it longer, then you'll get yield compression at the asset level. And I think the reality is over the last 12 months, we've deployed around 200 million into assets with a net initial yield of 6.2%. And clearly we've sold these assets just recently at 4.8%, which obviously clearly is evidence that there's quite a lot of arbitrage between the assets that we're looking to acquire and the ones that we're selling currently.
Okay, Richard, let's take a look at the share price chart, because we've got this move up from the lows, the COVID lows that we had last year, where we were around about, I think, around about £1 a share. 148 is where we are at the moment. You can see this big recovery that we got, in line with pretty much what the market's been doing. You're at the top end of the recent trading band. What's your message then to shareholders? If you're not calling the top of the market and you're quite happy with the business model that you've got, where do you go from here? How do you encourage new shareholders to come in?
Well, I think the first thing to say is that we still very strongly believe that the opportunity set that we saw at the beginning of 2016, late 15, is still absolutely there. That's the first point. There's over £4 billion worth of stock traded annually in our size range. We figured back then that if we acquired around £150 million worth of assets on an annual basis, 150 to 200, then clearly that would be a good base case for a 500 million market cap business by year 5. Now, our anniversary has just passed, so we're slightly behind the curve in that sense. But we've had some really unprecedented roadblocks put in the way over the last few years, which we could never have foreseen, in the shape of obviously general election, referendums, more recently the practical implementation of Brexit. So we've had a number of things that have made it difficult for us to raise equity in the public markets. But that said, as we sit here today, we see absolutely no reason why in the next 3 to 5 years we can't see our business growing to £1 billion market cap business. And we still see ample opportunities. So from our perspective, our total return has been peer group leading, and I think we can see there are lots of aspects to our strategy that are as strong today as they were then.
Yeah, that's a very ambitious target, of course, £1 billion. You've got, I think, market cap at the moment just shy of 380 million, to put that into some sort of context. If we talk to at the end of the year, what are we going to be talking about? How has the year gone, bearing in mind, as you said, we've gone through this Brexit process, you're having to deal with all the fallout from that. Where's the company going to be at the end of 2021?
At the end of calendar year 2021, I think we will be, as I say, we remain ambitious to grow. I think we would be keen to explore opportunities to grow our capital base through the course of this financial year. We have no fixed plans at this point in time, but that's certainly the ambition. We'll continue to asset manage our assets as we always have done, and we've been very, very active of late. As tenants are recognising that in a market that's starved of space, they need to make commitments for the medium term, because if we consider the fact that land prices have probably doubled in the last 5 years, construction costs have doubled in the last 5 years, therefore replacement stock is infinitely more expensive today than it was 5 years ago. And with an increased chance of inflation, I think people are, the occupiers are keen to fix their overheads and understand what their costs are going to be for the next 5 years. I mean, there's clearly a huge amount of supply chain sophistication still to happen, and particularly in the last mile area of the market. So I think we expect a very busy year.
Look, Richard, it's a pleasure. We'll have to leave it there, but thanks for joining us with this update on Urban Logistics REIT and where you're going with the company. That £1 billion market cap target, very much part of Richard's ambitions there. He's Chief Executive of Urban Logistics REIT, the company trading on the AIM market.